Hey guys, today we want to talk all about some things to be thinking about when you're buying your first house. But if today's your first time joining us, welcome. My name is Michael Foley. I'm a certified financial planner and student loan professional, and I'm also the son of two doctors. And I've really developed Lifestyle Creep to help healthcare workers and their families, really be more intentional in their finances and hopefully inspire them to live more humble and quiet lives. But let's dive in. So this is an exciting time. We're buying our first house and looking at all the things to be thinking about, and it's a little overwhelming, right? The first time you're trying to figure out all these different numbers. I remember the first time when I bought my first house, I was like, this is what I do for a living, but all the acronyms that they throw out when you're looking at these mortgages and all these things, there's so many things to be thinking about. And so I really want to break it down today and then think about some other considerations and have some other questions that you'll be wanting to think about at the end that make sure that's the right time and make sure they're making a wise financial decision with this house purchase as well. So we really want to break it down into two categories when you're buying a house. So the first category is your down payment. How much are we putting down? When do we need to put it down? What does that look like? What's reasonable? And then our monthly payment. How much is going to fit into our budget? How much should we be spending on our mortgage? What are stats on that? And what are some considerations around that? Okay. So our down payment and our monthly payment. It sounds pretty simplistic, but those are the big things we got to be thinking about. Okay. So let's break down our down payment. So as a general rule, if you put anything less than 20% down on the purchase of a new home, you would have to pay private mortgage insurance. So the acronym for that is PMI. So it's an additional insurance policy that you have to take out that essentially is a backup for the bank, because the bank is saying, well, hey, we want people to be putting a good chunk of their own money towards this house to make sure that they have some skin in the game. And if they're not putting 20%, we're a little bit nervous about that, and there's a potential that you might default on this loan and not pay the loan back, and so they take out an insurance policy to make sure you don't, right? So that's extra monthly cost that you have to pick up if you put under 20%. Now, that said, there are some professional loan programs like the doctor loan program. So many doctors, dentists, other professionals, nurse practitioners sometimes can fall in there as well, may also qualify for a doctor loan program that allows you to put less than 20% and not have to pay that extra insurance policy on that, called that private mortgage insurance. So they've identified that doctors, as a general rule, are pretty good debtors, and they don't tend to lose their jobs very frequently, and most of their doctor clients do repay their loan. And so just that demographic in and of itself, they're able to take the risk and will say, even if you put anything less than 20%, we won't make you take out that insurance policy because we know you're good for it. So it's a nice opportunity. The different doctor loan programs are out there. Some do let you put all the way down to 0% down. I would make sure that you're comparing that to conventional loans, though, because sometimes when they go all the way down to the 0%, they kick the rates up a little bit. Others don't. There are some that are really competitive and you just put 0% down. That's something that we got to be thinking about. But others are maybe 5 or 10% down payment. So we like to try to target that 5 to 10% down if we can. With interest rates being so high right now, we definitely like the more of the down payment, the better. And then also making sure that, because if we think about it, if we put 0% down on the house and then let's say the housing market goes down, well, we could be in a position where we're called underwater on the house, meaning that now the mortgage that we took out is, we owe more than the house is even worth, right? So that's a scary place to be. It doesn't matter as long as you make your mortgage payment, right? But if you need to sell that house, now you owe money to the bank to get out of that house. So we try to avoid those situations if we can. So putting a little bit of a down payment does give you a little bit more of a buffer on that. So the other thing that we need to be considering with the down payment is that there's also going to be closing costs. So there's other kind of a lump sum of other costs that go into paying for the mortgage origination fee, and there's a lot of other taxes, insurance, other things that we have to be paying as a part of the initial close of the house. So they're called closing costs. So sometimes it's maybe like up to 2% of the house cost. Maybe for like a $600,000 house might be about $15,000 extra that you have to come out of pocket on when you go to close. And so a lot of people forget to factor that into their equation with how much they're going to be putting down onto the house. And so they say, hey, we're going to put $30,000 down on the house. But really, when push comes to shove, that's actually like $45,000 when you factor in closing costs. So something to be thinking about, because we never want you to be in a position where we're stepping into home ownership and we don't have an emergency reserve. There's not a worse scenario for us in that situation. So we want to make sure that we're able to have a good reserve tank after that. The biggest mistake that we see is people jumping into home ownership, putting all of their cash into buying a house, and then now not having any emergency reserves and now having the liability of a new house. So, when my wife and I moved into our first house together, we needed to redo our entire roof in the first month. So I don't know if you guys have done a roof before, but that's like 10 or 15 grand. And so that's, if we didn't have an emergency reserve when we were buying that original house, that would have had to go on credit cards or had to have family support or other things that we would have to pull on. So sometimes we don't have that extra support, and then we could be in a bad spot right out the gate. And now I'm going to pick up a higher monthly payment potentially as well. We don't want to get into that. But one cool trick that you might want to ask your realtor about is they're called seller concessions. So sometimes, depending on how you place the offer on the house, you might be able to actually get the seller to pick up the closing costs. So essentially, you put your offer in a little bit higher than they're asking so that you can essentially finance those closing costs. And so at the end of the day, the seller is getting the same amount of money, but it just is a little bit different on the paperwork by giving you some seller concessions that will limit the amount that you have to come out of pocket. But sometimes in these competitive markets, a lot of the realtors aren't able to do that because it makes it a less competitive bid oftentimes, but something to ask your realtor about for sure, okay? So those are some considerations with the down payment. We want to put a good amount of down payment, but we don't want to sacrifice our emergency reserve. So that's also going to be determined about what we can afford. So how much can we afford to still keep maybe that 3 to 6 months of expenses on hand, okay? So now the second thing that we want to look at is the monthly payment. So when we look at the monthly payment, a lot of people run these calculations online, and they run the mortgage calculator, which calculates the principal and interest. So that's if you take out a $500,000 loan, principal and interest payments for 30 years, here's your interest rate, that spits out a payment for you. But a lot of people forget that there are some additional fees that are factored into your monthly payment. And so we call it PITI, P-I-T-I. So we got to make sure that we're adding in our principal is the P, I is the interest, taxes, so we have property taxes that we owe, and then insurances. So you have homeowners insurance we have to factor in, okay? So the common phrase is PITI or P-I-T-I. That's kind of our true mortgage payment. But we also got to factor in any HOA costs that we might have, and any other costs that might be going into that kind of escrow account, which is going to be paying your insurance and your property taxes, because that comes out monthly in your monthly payment. So in some situations, some property taxes are really expensive, and so it could add another $500, $1,000 or more, to your monthly mortgage payment. So if we're planning based off of, a $4,000 per month payment based off of just principal and interest calculators online, but we're not factoring in all the other fees and things that we have to be accounting for with the taxes and insurance and maybe HOA, well, then we're not really getting a true depiction of what your monthly payment is going to look like. So some of the new sites like Realtor or Zillow, some of those offer some great mortgage calculators that give some estimates as to what your insurance and what your taxes might be based off of historical records that they have on the property. So make sure we're working off of those, not just a random mortgage calculator online, because that can be really can skew things quite a bit. Okay, so the big thing that we want to look at is when you go to talk to a mortgage agent, they're going to tell you what you qualify for. And so what they qualify for, we got to make sure that the word qualified does not mean affordable, right? That doesn't mean that we can afford that per se. That just means what the bank is willing to risk and to allow you to take out in a mortgage. So what they typically will do as a general rule is they'll look at how much gross income comes in your situation each month. They subtract out any current debt payments. So if you're making any student loan payments, if you're making any car loan payments, any other personal loans, they subtract that out. And then whatever is remaining, they cut it in half. And so it's usually 50% of whatever that amount is. And that's what you're going to be eligible for in that total monthly mortgage payment amount. So sometimes it's ridiculous to see, how much you qualify for as far as a mortgage is concerned. And that really probably is not in the affordability metric though. And so our CFP board, or Certified Financial Planner board, recommends that we keep that mortgage payment, so that PITI, all within about 28% of our income. And so we typically go off of our take-home income. So if you're bringing in, after taxes and everything, maybe $10,000 a month, we want to see that mortgage payment be somewhere around that $2,800 to $3,000 per month. Okay. The other factor that we want to be looking at is called the 36% rule. And so the 36% rule is when we factor in all of our debt payments. So our mortgage, our car loans, any student loans, any other personal loans, credit cards, all of our debt payments should be under 36% of our total monthly income. So using those as a guide from affordability, we share some of those with our clients that are moving to California, and they're like, what do you want me to live in a shack? There's there's so many things you can afford, right? But those percentages are there for a reason, right? And so if we can't stay within those metrics, that means that we're putting more value in our financial plan and where we're living. And there's nothing wrong with that, but we just got to make sure that we know where we're sacrificing elsewhere in the plan. As if we're not making sacrifices elsewhere in the plan, other savings and other things could be hurt and put you in a really tough and kind of what we call a house poor position. So it really got to be thoughtful about what that mortgage payment is going to look like. But the other thing that we want to be looking at too is we discussed some of those situations that maybe you can go underwater in the house where now you owe more than the house is worth. We always want to look at kind of what is our fallback option. So let's say we buy this house, we love it for a year, and then we hate the job that it's right next to, and we end up needing to move, and we want to move. So we got to sell that place. Well, now if we're underwater in the house, our only option is really going to be to either sell it and pay money back to the bank, right, which is not ideal, or we've got to rent it out, right? And so that it's always wise to look at, okay, if we were to, this house that you're purchasing, what would it rent out for? And if you were to look at the rental market for that equivalent house, is that monthly mortgage payment comparable to what it would be renting out for? And if it's not, that's definitely an additional risk that you're taking, because that's going to make it harder to offload that house in the future. So we typically, with this volatile market that we're in, we typically like people to be comfortable owning the house and making sure that we can make that mortgage payment for the next 10 years. Right. So if it used to be a lot shorter when the market was going nothing but up, right? But now it's a little bit shaky. It could go either way here. And so we want to be really prudent with what we're doing and from a monthly payment. So comparing that to what you could do to rent it out, will help you kind of get a gauge of, okay, are we really overpaying for that? And maybe should we put more down payment to drop that payment in, right? So those are some different things to be looking at. But so looking at how much we can put down and what is going to fit into our budget on a monthly basis, and then how does that compare to, if we were to rent it out, using those and asking those questions are really going to help you determine affordability for your own situation. And so identifying, we have people ask, what can we afford? But, asking yourself those questions and really breaking it down into the budget. And then, also identifying, we want to be intentional with our money, and are we, is this where we want to put our value? And the last two questions that we always want to ask as we're heading into this big financial decision is, one, is this the right time? Right? So everyone that you're talking to, the realtor, the mortgage lender, family, friends, your spouse, everyone's going to be excited and want you to buy this house as soon as possible, right? But is this the right time? I want to play that devil's advocate just to make sure that zoom out for a second and say, hey, big picture, is this the right time? or is this going to cause undue financial stress for our family or for us at that time, right? And maybe would it be a lot less stressful if we did that in like a year and maybe rent it for another year? So keep that in mind. And then the other thing is always ask yourself, is this a rushed financial decision? Am I feeling like I'm rushing into this, prematurely? As the proverb says, he who hurries his footsteps errs, or as our team says, haste makes waste. Anytime we're rushing into a big financial decision, don't make a 30-year commitment on a loan based off of some short-term, maybe contingencies or short-term considerations, right? We really want to be looking big picture. Is this the right time? And am I rushing into this? Because if you are, then, maybe we need to take a pause and really evaluate the situation, make sure we're on track. But so hopefully this has been helpful just to help you identify, what is an affordable, house purchase? What are some things that I should be thinking about in our finances? So you can lead you to be making a more intentional financial decision when it comes to a house purchase. So thanks so much for spending some time here today, and hope this has been valuable for you, and we'll see you in the next episode. Thanks so much.